Let's say you want to start with investing. You have saved up some money and you think it is about time. But where do you start? Well, in today's video I'm going to explain how to start investing for beginners. My name is Thomas and this is ThomasInvest. When you want to start with investing, it might be a bit overwhelming at the start. You have tons of different options to begin with. You can invest in real estate, the stock market, assets and many other things. Today we focus on the stock market only. The main reason is that it is easy and you can start with only $1. The general idea of investing is that you buy something today and you want to sell it at a higher price in the future. The money that has been made here is what you call profit. And to me there are three important key elements when it comes to investing. Your goal, the amount of money you have available now and in the future, and your risk tolerance level. Let's start with your goal. What is it that you want to achieve? Financial freedom, retire early, some extra income to pay the monthly bills, or something else? It may all seem the same, but there is a big difference in these specific goals. Take your time to write down your specific goal. It is really important that you have a clear vision here. The second thing to do is finding out how you would achieve this goal. Let's say you want to retire at the age of 50. This means you need a certain amount of money depending on your lifestyle and location. But let's aim for $1 million. If I already have $50,000, it would be a little easier to get the ball rolling instead of starting with only $1. So it's very important to find out how much money you have available right now. And only use the money that you can miss, because the stock market will crash sooner or later. More on that in a minute. Does this mean that you cannot start with only $1? Well, of course you can. It might take you a few years, but it isn't impossible. In fact, I've heard stories where people started with $100,000 and failed. And also stories where people started with only a penny and succeeded. Next to starting capital, it is very important to decide if you want to add weekly, monthly or yearly contributions, or not at all. I think without this it is nearly impossible to achieve $1 million. And again, it doesn't really matter if you add $10,000 a month or $100. All that matters is that you start and get the ball rolling. Because we want to achieve in the end is the snowball theory, where you start small and really slow, but over time the snowball gets bigger and bigger. The last key element is risk tolerance level, and this is really important. For example, we have two people, John and Paul. John is at the age of 20, while Paul is at the age of 40. If both want to retire at the age of 50, John has still 30 years left to correct his mistakes or market crashes to survive. So he might have a higher risk-reward ratio than people who have only 10 years left of the investing story. Paul might want to invest in more reliable stocks. So depending on your goal and your age and personal preferences, your risk tolerance level is very important to know. And this will change over time, so make sure to zoom out every now and then and look back at these three key elements to make sure you're still on track and in line with these three key elements. Now that we have discussed the three main key elements, it is time to see what type of stocks there are. And to me you have two options, growth stocks and dividend stocks. The main difference being the dividends. The idea behind growth stock is that you buy them at a certain price and in the future you sell them at a higher price. This might be the next year, in 5 years or even in 20 years. The profit you make is the difference between your buying and selling price. As a beginner it is really hard to pick the right stocks and get a decent profit. So that is why most people start with dividend stocks. And within dividend stock you have many options. Some of the biggest companies in the world pay a dividend. Essentially it is a small part of the profit they make. Most of the time dividend stocks pays 4 times a year a small amount to shareholders for owning the share and rewarding them for that. Depending on the type of stocks, this may vary between 0.5 and 4% in general. And of course there are companies that pay 10%. But we learned that a key element is risk tolerance level. Higher percentages means higher risk most of the times. Within dividend stocks, you have also the option to focus on reliable paying companies that pay a solid dividend, such as 3M, Home Depot and Johnson & Johnson, for example. Of course, you can focus on what we call dividend growth stocks. These are companies that are not only paying dividends, they also increase the dividends at a high pace, meaning you get more dividends over the years. To me, the opportunity of succeeding lies within a combination of these stocks. Don't bet on one horse or you will end up losing. And the main reason why people fail is pretty easy to avoid. First of all, most people do not have the patience to wait 20 to 30 years. And I know there are many stories of people becoming financially independent within a few years. But the vast majority of us will need to wait 20 to 30 years before being able to retire. And that's where most people fail. At some day they need to pay some unexpected bills. They get divorced, they lose their job or whatever reason, but they need to cash out their money in order to continue on with their life, which is very unfortunate of course. The second reason why people fail is because they don't have a long-term vision. And this is kinda in line with reason number 1. But I also mean that buying tobacco stocks today might not be the smartest thing to do, because the world is changing. I'm not saying you shouldn't buy them, but it is something to think about. The last reason is also in line with the first two reasons, and that is that people sell their stocks when the stock market crashes. And it may sound weird at first, but you should not do that and do the exact opposite. When you look at the S&P 500, which is an index of the 500 biggest companies in the US, we see that at some points in history the market crashed big time. We have the 2000 dot-com bubble, the financial crisis and the coronavirus. And they had two things in common. The stock market went down big time, but it also recovered at some point and continued to increase from there. And this is very important to keep in mind when you start with investing. When the market crashes, most people without a long-term vision cash out. They are scared and don't have a clear goal, risk tolerance level, or they need that money in order to basically survive. And don't get me wrong here, I'm not calling them chickens or anything. Sometimes you have to cash out or sell even if you don't want to. But when the market is going down big time, it will go up eventually. It might take a few months, a few years or even a decade, but at some point the market will go up again. And when you buy shares when the market crashes, you can pick up great shares at a big discount. So it is very important to have some money on the side, a clear goal and a risk tolerance level. And let's not forget that 80 to 90% of the people is not able to beat the market, even the so-called experts. So why focus on beating the market if you can match the market and beat 90% of the people? Now that we covered that part, I want to zoom in on how I think my ideal portfolio would look like if I had to start all over again. Let's say I'm at the age of 20 to 30. And I have $10,000 available. I want to retire at the age of 50 and I have a low risk tolerance level, meaning I want to avoid high risk, high reward companies. I want to invest $5,000 into the S&P 500. I know over a longer period of time this will give me an average of 10% per year. And it might be that there are some years with a negative return or 0% return. But again, over a longer period of time I'm pretty sure to get my 10% average annual return. I want to invest $2,000 into dividend growth stocks. This means companies that are paying dividend but also focus on growing the business and with that the dividend. This assures that the snowball will get rolling at a faster pace when I reinvest those dividends. I also want to invest $1,250 into growth stocks. I do think they can be a great addition to anyone's portfolio, but I want to minimize my risk. Also because I want to invest another $1,250 into what I call dividend income stocks. These are stocks that focus on paying dividends at a high rate. They do come with a risk, so that is why I keep them under the 12.5%. My last $500 are going to this so-called cash position. This is used for whenever a stock is at a great discount or the market crashes and I want to buy more stocks. Now that we have our portfolio written down, it is time to see how long it will take for me to retire. And for that I use the compound interest calculator. This is a tool that you can use to see how long it will take you to get to your goal. So let's say our goal is $1 million. We fill in $10,000 initial investment for our portfolio. We have a monthly contribution of $500 and we do that for 30 years. And an estimated interest rate of 10%, the market average. After 30 years we reach $1.1 million. And the interesting thing here is that you can really see how the snowball works. It takes you 9 years to get to $100,000. After that it takes you only 5 years to get to $200,000. And as time passes by, your portfolio will skyrocket. Now let's change the numbers a little bit. Instead of contributing $500 a month, I'm putting in $750. And instead of 30 years, I put in 25 years. Now we're looking at almost $1 million, but we saved 5 years at the end. Now let's change the 10% return to 12% return because we feel really comfortable about us beating the market. We see that we are looking at 1.37 million in 25 years. And now for the final one, let's start with $25,000 instead of $10,000. You see that we will end with 1.6 million, only because we started with a $15,000 extra at the beginning. And as I said at the beginning of this video, it doesn't really matter if you start with $1 or with $10,000. It all comes down to having the patience to wait 20 to 30 years before you can retire. And maybe the person who starts with $10,000 can retire earlier than you can, but the result is the same. You both can retire early. And now we are getting to the end of this video, but not before I give you my personal advice, which is start investing as early as possible, even if you only have $100 to begin with. It doesn't matter at the beginning. All that matters is that you start investing and get this snowball rolling. My second advice is don't focus on the short-term results. Sometimes people brag about them beating the market or that they have found the next Apple or Tesla. In the long run this doesn't really matter. You only hear the winners and not the stocks where they lost a lot of money. So don't focus on the short-term results or winners. Focus on the long term. And the next one is also in line with my second advice. Don't listen too much to the so-called experts. It is always a good thing to gather as much information as possible, but the experts are wrong most of the time anyway, so focus on your own research. And the last one, enjoy the ride. Zoom out every now and then. See what you already have accomplished, because by investing you already made a huge step towards financial freedom. And this was the full guide on how to start with investing for beginners. I hope you enjoyed this video. Please let me know your thoughts on this video and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.